Every year, millions of people try to turn trading into a shortcut. The problem is, the math keeps saying otherwise. In a Brazilian futures study, 97% of traders who lasted more than 300 days still lost money. U.S. data tell a similar story. About 72% of day traders end the year in the red. Even among professional prop traders, only about 16% were profitable, and just 3% earned more than $50,000. Meanwhile, the S&P 500 has averaged about 10% a year since 1957. So before anyone picks a strategy, the real question is simple. Which path actually has the best odds? Day trading looks exciting because it feels active. You are in and out of positions all day, chasing small moves and trying to outsmart the market in real time. But that speed comes with a brutal cost. Bid-ask spreads, exchange fees, and taxes. And as of FINRA's 2026 update, the old $25,000 pattern day trader minimum has been replaced by new intraday margin standards. That makes day trading easier to access, but it does not make it easier to win. The reason is simple. Most of the edge disappears once you subtract friction. On top of that, short-term trading gains are taxed as ordinary income, while long-term gains get much more favorable treatment. That is why day trading has such a harsh reputation. It is not just that most traders lose. It is that even the winners often do not keep enough after costs and taxes to make the effort worthwhile. A trader can be right on the chart and still lose money in the account. That is the trap. And once you understand that, the next question becomes obvious. If day trading is this difficult, is swing trading any better? Swing trading sits in the middle. You hold for days or weeks instead of minutes, which means less screen time and less stress. In theory, that should make it easier. In practice, it is still hard to beat the market consistently. Some traders do better here than in day trading because they are trying to capture larger moves, but the same problem shows up again. You still have costs, still have taxes, and still need discipline. In one large retail trader study, swing traders did better than day traders, but the edge was still modest after costs. The strategy can work, but only if you have a real system, not just confidence. That is the part most people miss. Swing trading is not magic. It is just a slower, slightly more forgiving version of the same game. If you do not have clear entries, exits, and stop-loss rules, the market will eventually expose that weakness, and even if you do have a system, you still have to execute it consistently enough to overcome fees, taxes, and bad stretches. The hard truth is that very few people do that well over time. Now compare that with passive index investing. Instead of trying to outguess every move, you buy the market and let time do the work. That is the boring answer. But boring is often what wins. Fidelity says the S&P 500 has averaged about 10% a year since 1957 and about 11.5% over the past 40 years. Index funds like FXAIX charge almost nothing by comparison. Morningstar lists its expense ratio at 0.015%. When you combine low costs, compounding, and long-term tax treatment, the gap between passive investing and active trading gets wider and wider. That tax difference matters more than people realize. Short-term gains are taxed at ordinary income rates, which can run much higher than long-term capital gains rates. Long-term investing, by contrast, can qualify for much lower rates, and tax-advantaged accounts can delay the hit even further. Over a decade, that difference compounds into real money. This is why an investor can do less, stress less, and often end up with more. Now let's make it concrete. Say you start with $10,000. If you day trade and somehow break even before costs, you still may end up flat or slightly down after expenses, taxes, and bad fills. If you swing trade well, maybe you can compound into something meaningful, but only if you are unusually disciplined and consistent. If you simply buy a low-cost index fund and let it compound at a market-like pace, the numbers quietly stack in your favor year after year. At 8%, $10,000 grows to about $21,600 in 10 years. At 10%, it grows to about $25,900. That is the power of time working with you instead of against you. And this is really the core of the story. Day trading is not impossible, but the odds are awful for most people. Swing trading can work, but it still demands skill, discipline, and a tolerance for uncertainty. Index investing is slower, but it is also simpler, cheaper, and historically far more reliable for ordinary investors. The active trader has to be right over and over again. The index investor just has to stay in the game. So the conclusion is not that trading is useless. The conclusion is that most people overestimate how much skill it takes to win and underestimate how much friction eats into returns. If you love the adrenaline, you can trade. But if your goal is to actually build wealth, the market has already handed you the answer. Keep costs low, keep taxes low, and let compounding do the heavy lifting. Excitement can make a great story. Compounding makes real money.